The current stock price for Applied Digital Corp, traded under the ticker APLD on the NASDAQ, is $36.09, reflecting a strong intraday movement, up plus 5.40% as of the moment of this generation on Tuesday, October 21, 2025, during market hours. This significant daily pop follows a period of intense volatility and profit-taking, and it highlights a crucial, often overlooked dynamic in the APLD story that goes beyond the headline-grabbing AI contracts. The market is finally, and perhaps belatedly, starting to price in the near-term operational de-risking of their massive new data center build-outs. The common surface-level expectation for Applied Digital is a simple binary read. It's an AI infrastructure proxy, riding the coattails of giants like NVIDIA, with its stock price soaring and dipping purely on sentiment around artificial intelligence demand and its headline $11 billion in contracted revenue with Coreweave. That narrative, while compelling, is incomplete and frankly keeps investors focused on the distant horizon rather than the current construction zone. The deeper reality is that APLD's stock performance this week isn't just about the promise of future revenue. It's about tangible, on-the-ground progress and the recent strategic moves that make that enormous contract revenue stream feel more secure and less like a speculative aspiration. The recent move to raise the minimum conversion price floor for its Series G convertible preferred stock from a previous $22 to a more assertive $34, aligning it with the current market valuation, is a subtle but powerful signal. This isn't just administrative filing, it's management telling the market, we believe our stock's floor is significantly higher than before, and we are protecting common shareholder value by making it more expensive for preferred holders to convert at lower prices. That kind of conviction, backed by physical progress on sites like the Polaris Forge 2, is the true catalyst driving this strong intraday climb, not just the general AI buzz. Looking closer at the recent stock movement, the sheer trading volume today is notable, far exceeding its 30-day average, suggesting a major inflow of institutional or high-conviction individual brokerage money finally rotating back into the name after a pullback. In the days preceding this surge, we saw the stock experience a sharp, nearly 7% drop in one session, largely correlated with the decline in Bitcoin price, which is the expectation versus reality tension in a microcosm. The market instinctively treats APLD like a crypto-linked stock because that's where the company's initial revenue base was derived. The reality, however, is that the high-performance computing and artificial intelligence contracts are now the primary driver of forward-looking valuation, yet the stock still gets dragged down by crypto sentiment. This misclassification creates opportunities. When Bitcoin pulls back, the stock is irrationally punished, and savvy traders, leveraging platforms like Interactive Brokers for their advanced data and execution, are stepping in to buy the dip, recognizing the AI contracts are completely insulated from crypto volatility. This tension, the stock behaving like a crypto asset when it's structurally transforming into an AI infrastructure giant, is the core thesis for why its volatility is so high, and why its recovery moves are often so sharp. The institutional activity over the last quarter has been a mixed bag, which adds to the narrative of confusion and opportunity. Major players like BlackRock and Vanguard Group, which are staples in many Fidelity Investments and Fidelity ETFs portfolios, have been active, adjusting their positions, while some reduced their exposure, likely taking profits after the enormous run-up from the early year lows. Others, such as Goldman Sachs and Morgan Stanley, executed significant increases in their holdings, reflecting a bifurcated view on the stock's near-term risk profile versus its long-term potential. The increase in aggregate institutional shares held, with 184 holders increasing their positions versus 129 decreasing, points to a net positive signal that the sophisticated segment of the market, those who would use robust tools on a Fidelity brokerage or Interactive Brokers platform, is gradually building a consensus on the viability of the AI strategy. It's the difference between trading the volatility, selling high, buying low, and investing in the story, accumulating shares on conviction. For those still trying to piece together the fundamentals, Applied Digital Corporation is a designer, developer, and operator of next-generation digital infrastructure across North America, focusing on providing high-performance computing (HPC) solutions, especially for the artificial intelligence and blockchain industries. Their business model is essentially built on two main pillars, though one is rapidly overshadowing the other. First, their original data center hosting business, which provides energized space for crypto mining customers. This is the segment that ties them to Bitcoin price movements. Second, and now the centerpiece, is their HPC hosting and AI cloud services, which involves designing, constructing, and managing specialized data centers and GPU-as-a-service solutions for critical AI and machine learning workloads, highlighted by the huge Coreweave partnership. The older narrative, rooted in past performance, was one of high operational expenses, low gross margins, around 5.58% historically in some reports, and high debt, which gave it that high-risk penny stock feel. This historical picture, with its negative price-to-earnings ratio and liquidity concerns, is the expectation that is being fundamentally challenged by the new reality of massive, long-term, high-margin, contracted AI revenue that promises to expand gross margins significantly. The transition is why the stock is so volatile. It's moving from one valuation framework to a completely different one, a leap that often generates a lot of friction and dramatic price swings. The recent fiscal Q1 earnings report was a pivotal moment. The company reported adjusted EPS of -0.03, which significantly beat the analyst consensus, and revenue of $64.2 million, surpassing projections. While the net loss remains and operating cash flow is still a challenge, the beat on the top and bottom lines was enough to exceed the low expectations set by the market's memory of their previous crypto-focused challenges. The market focuses on sequential revenue growth, and the reported quarter showed just that. This is a classic tension. The reality of a continuing net loss is bearish, but the reality of rapid, above-consensus revenue growth in the right direction is intensely bullish for a growth stock. For an individual brokerage investor using a platform like Robinhood or SoFi Invest, seeing that kind of massive revenue growth, even with a loss, is often all the signal they need to buy. Looking ahead, the future outlook for Applied Digital hinges almost entirely on execution and financing. The core opportunity, the reality that must be delivered, is the successful and timely construction and activation of their new AI data center campuses, like the multi-billion-dollar Polaris Forge 2 in North Dakota. Each development milestone, from breaking ground to turning on the first set of servers, serves as a major catalyst that de-risks the $11 billion in contracted revenue. The risk, or the potential for expectations to fall short, lies in the sheer scale of the capital expenditures required. The company's liquidity, as noted by its current ratio still below a safe benchmark, remains a genuine concern. They are building a massive infrastructure business in a capital-intensive sector, and any hiccup in financing, such as issuing more convertible debt or preferred stock, or delay in construction, could spook investors and trigger a deep correction. The macroeconomic pressures, particularly rising interest rates that make debt financing more expensive for infrastructure development, also play a role in the stock's day-to-day pressure. On the flip side, the opportunity is immense. In a world where the demand for NVIDIA stock GPUs for AI training is insatiable, owning the physical space and power to host them becomes extremely valuable. Applied Digital is selling power at the rack, and if they can execute, the sheer recurring revenue from their long-term contracts will completely flip the financial model, moving them towards sustained profitability and a much higher, more stable valuation multiple. We are seeing analyst targets, following the strong earnings and the preferred stock conversion floor increase, now being raised to the low $40, a testament to the belief in the long-term execution. The transition away from the crypto narrative is critical. The faster the AI HPC segment dominates revenue, the more insulated the stock will become from external crypto market forces. This is a stock where you need to look past the dramatic daily swings and focus on the strategic wins. The volatility is baked in for now because the market is wrestling with a former crypto play that is morphing into a pure-play AI infrastructure stock. The recent rally is a vote of confidence in management's execution and their strategic defense of the stock's value through measures like the preferred stock floor. It's not a buy-and-forget name. It requires active tracking, much like managing your own portfolio through a service like Schwab Intelligent Portfolios or using the active trading tools on the Fidelity mobile app. This is not about passive online investment. It is self-investing at its most dynamic. So let's get a sense of how convicted the retail community is on this transformation. Comment below what percentage of your portfolio you have allocated to high-risk, high-reward AI infrastructure plays like APLD, and do you see them as a better long-term investment than the GPU makers like NVIDIA stock itself? In summary, the expectation that Applied Digital is an easily categorized volatile crypto proxy is being fundamentally shattered by the reality of its rapid, successful execution in securing and now physically building out one of the largest contracted AI infrastructure deals in the market. The massive stock run and the current intraday move are less about a general AI tide and more about a calculated, strategic de-risking of their financial structure and operational schedule. The company's story is the perfect example of a high-beta growth stock where the pain of construction costs and negative near-term cash flow